Joined now by Lindsey Piegza. She's chief economist at Stifel Financial. Lindsey, great to see you. Let's start with the Fed minutes. What are you going to be watching today?
Well, I'm going to be looking for the conversation around inflation. Now, remember, the minutes came out before we saw the latest inflation uptick, but I will be looking through the details of the conversation to see, is there a rising level of concern about the lack of disinflation momentum? Is that a possibility in terms of if we see a reversal in inflation, will that change potentially the pathway for policy? So that's going to be one of the primary pieces of the minutes that I'm going to be looking for. The other one is there any kind of conversation around how long the Fed is going to keep rates at the terminal level? Much of the conversation up to this point has been how high, but are we starting to shift the conversation towards how long are we going to remain at these elevated levels, given the fact that much of the committee assumes that we are nearing that terminal level, not necessarily at it quite yet, but certainly nearing it with the expectation of one, maybe two additional rate hikes before the end of the year.
And I guess one consideration in all of that is whether or not the economy can remain resilient. We were having a comparison conversation about Canada, where you are starting to see some signs of consumer strain. But this week we got some retail sales data in the U.S., which I think got the market thinking, well, hold on a second. If the Fed wants to keep getting that inflation story under control, they might have enough data points to speak to on that.
Well, the consumer certainly appears to be very resilient here in the U.S., complicating the outlook for the Fed, because remember, the Fed is intentionally trying to slow demand in order to result in more benign inflationary pressure. So the longer that the consumer, the labor market push back against tighter monetary policy, the stronger the response from the Fed must be in order to achieve that price stability. But you're right, the retail sales numbers were pretty impressive. That being said, there are some signs of the consumer losing momentum. When we parse out some of that month-to-month volatility, there's still a very well-established downward trend in terms of spending activity. We were up near 8% at the start of the year. We're now down 3%, even with last month's uptick in monthly purchases. So I do think the consumer is still on solid footing. There's a lot of artificial supports out there, but it's far from a robust scenario at this point.
Lindsey, I want to try to look out a year, maybe even 2 years from now, because I think everyone's trying to figure out some kind of pivot point, because there's some historical market performance you can look at when you start to see a change in what central banks are doing to fight things like inflation with higher interest rates. But there's this other conversation piece around the fact that we do need to get used to the idea of higher rates for longer. What are you going to be watching play out, let's say, over the next year?
Well, I think first and foremost, the Fed has been very clear that rate cuts are not in their base case scenario for 2023 and likely not even 2024, depending on what we're seeing in the inflation data. So the notion that once we reach the terminal rate, the Fed has nowhere to go but down, I don't think that scenario is going to play out this time around. Because if you think about the inflationary picture, it's very different than what we've seen in previous cycles. We had a number of different inflation metrics get us into the position that we are right now, facing still elevated, very sticky price pressures. And the Fed can only control the demand side of that equation. So even after we see the Fed reach a sufficiently restrictive level to tap down the demand side, there's no guarantee that inflation will continue to subside if we see some of these other pressures, corporate side inflation, supply side inflation, leave price is elevated. So I do think that the scenario of higher for longer is the most realistic pathway for rates at this point.
Okay. And so I guess at the end of the day, if you do see this higher rate environment as the new reality, is the recessionary risk a reality at this point? Because I know a lot of people started to put the idea out there that maybe if you've got higher interest rates and consumers are still spending, you can just altogether avoid a recession.
Well, I think the downturn has been deferred. It's been pushed out, but it hasn't entirely been deterred. I do think as the Fed continues to raise rates, continues to compound pressure on investment, on consumption, we will eventually see that downturn. But the timeline to reach that has been surprisingly long. Well, I shouldn't say necessarily surprising, unexpected, but given the amount of fiscal support, the amount of fiscal stimulus, the access to credit cards, drawing down savings, 401k access, all of these temporary supports have allowed the consumer to extend that pathway before we reach that downturn. But when you talk about raising rates the fastest pace in decades, we will eventually see that pressure come to fruition in terms of resulting in downward pressure on top line activity, which is essentially a long way of saying we do expect the downturn to come likely at the start of 2024, but even if it's somewhat later than that, it will eventually rear its ugly head.
Lindsey, appreciate